Hi, good morning. Today's topic is receivables management. Receivables management, as you all know, that how the firm sell the goods to the customers and how the firm collect the cash from the customers. That's known as receivables management. So there will be some kind of policies adopted by the managers for allowing the credit to the customers, which is known as credit policy. There are some organizations who are allowing the credit very liberally to the customers. That's a liberal policy. There are certain organizations allowing the credit very strictly to the customers. That is known as very aggressive credit policy. So there are different types of credit policies adopted by the organizations. So what will be the credit policy? The most important objective of this credit policy is maximizing the sales. There are two objectives behind each and every credit policy. First objective is known as maximization of sales. To increase the sales, definitely the firm must allow the credit very liberally to the customers. So that's one of the objectives of credit policy. And second objective is allowing the credit to the good customers and reduce the bad debt loss and reduce the production costs, reduce the selling cost as well as all other costs. That is another objective of the credit policy. So basically credit policy has got two objectives. One is known as maximizing the sales and second one is incremental profit. These are the two objectives or goals of credit policy that adopted by the organizations. Let's look into the components of receivables management. So we discussed that what's the meaning of receivables management. Receivables management is known as how the firm sell goods to the customers and how the firm collect the cash from the customers is known as receivables management. So this receivable management consists of three important components. The first component is known as terms of sale. It clearly specifies and establishes how the firm sells the goods and services to the customers and what are the terms and conditions between the buyer and seller in that particular agreement. That's the most important part of receivables management. The first one is credit period. How many days credit will be allowed by the company to the customers, which means that how many days the customer can take for making the payment to the company. Is it 30 days or 40 days or 50 days? How many days credit period can be enjoyed by the customer? That is the first and most important agreement term which is mentioned in the terms of sale. And second one is known as cash discount. If the customers are making the payment very fastly, they must get certain kind of discounts from the company. That discount is known as cash discount. This discount exists for how many days? Say for example, the customer is making the payment within 10 days, they will get discount. That period is known as discount period. That should be mentioned in the terms of sale agreement. And what type of credit instrument used for making the payment? Is it check, DD or some other methods of payment? What is that? It should be mentioned in the terms of sale agreement. So terms of sale agreement contains these important things: credit period, cash discount, discount period and type of credit instrument. And second important component of receivables management is known as credit analysis. This clearly specifies and establishes what type of customers are with the company. Good customers are there, bad customers are there. You can classify the customers into two categories: good customers and bad customers. That is the purpose of credit analysis. So credit analysis clearly classifies the customers into two categories based on their method of payment. And third one is known as collection policy. Collection policy, how well the firm can collect the cash from the customers. The company can adopt some strict measures for collecting the cash from the customers. So what kind of policy has to be adopted for getting the cash from customers is known as collection policy. So these are the components of receivables management. The first one is terms of sales, and second one is credit analysis, and third one is collection policy. And let's look into the credit terms. Usually when one company is selling the product to the customers, ABC company is selling the product to Mr. X. And definitely ABC company will tell Mr. X, you can make the payment after 30 days. That's the maximum time period which you can take for making the payment. So this is known as credit period. Then the ABC company will tell to Mr. X, If you make the payment within 10 days, you will get discount. So that discount is known as cash discount. So that discount percentage will also tell, if the product price is 1000, cash discount is 10%, 1000 into 10 by 100. So that much of amount will be deducted from the total price. The customer want to pay only that much of price as for the product. That's a cash discount. And third one is discount period. But if you make the payment within 10 days, then only you will get the discount. The company will clearly specify that. That is known as discount period. So definitely these credit terms contain these important things. How many days credit period will be given by the company to the customer, and what is the percentage of cash discount offered by the company to the customer, and for how many days this discount offer exists, that is discount period. Everything will be there in the first and most important component of the receivables management, that is known as credit terms or terms of sales agreement. And second part of receivables management, we discussed that credit analysis. Credit analysis is nothing but identifying the customers and classifying the customers into different account heads. So from the face of the customer, we can't say that whether he is a good customer or bad customer. You want to carefully evaluate, examine based on 5 C's of the customer. The first C is known as character. The character of the customer must be able to understand from trade references, bank references, from others' opinions and all. You're collecting this character of the customer. That's one method. And second one is capacity. The financial capacity of that person. The capacity of the customer is really good, then definitely it will also consider. Then economic conditions. The company might have been existed from the 10 years back, but now the condition is not very good. So there is no need of giving the credit to that customer. So economic conditions should be assessed. Then the fourth one is capital. Capital, total amount of capital vested with their business, that has to be studied for giving the credit. And fifth one is collateral. Collateral means the total value of the assets that pledged with other banks and financial institutions. They have got a lot of assets, but they pledged it with other banks or financial institutions. Then their condition is not very good. So you want to evaluate these 5 aspects: character, capacity, conditions, capital and collateral. So you will understand whether that customer is in a good account category, bad account category or marginal account category. Good account means those customers who are making the payment very fastly, and bad account means they are not making the payment at all. Marginal account means they are delaying in making the payment, but they will make the payment. So likewise, you make a categorization of customers based on the credit analysis. And there are certain models like ultimate set score model has been used to check the bankruptcy of the customer's conditions. And if that particular customer is in a bankruptcy condition, that customer will come under the bad account. So you can identify whether that customer is good, bad or marginal in nature using all these technical tools and all. Then the last component of receivables management is known as collection policy. The most important part of credit policy or the receivables management is collection policy. How regularly companies collecting the cash from the customers, and what is the mode of mechanism that has been used for collecting the cash, check, DD from the customers. Is there any lockbox system, or is there any some other mode of mechanisms for collecting the cash or check from the customers? And who is responsible for collecting the checks from the customers? So the bank manager or the company manager, who is actually responsible for collecting the cash and check and everything from the customers, which is very important, has to be followed very properly. And each and every customer's case has to be taken into consideration and give maximum careful attention to each and every one for getting back the cash from the customers. So these are the important aspects to be covered in collection policy. And finally, the credit evaluation of customers must be made properly from the financial statements of the customers and bank references of the customers and trade references of the customers, and evaluate the profitability, liquidity and all other financial aspects of that particular customer through financial analysis. Everything should be made to know about that customer in detail. So then only you will understand whether that customer is good or bad. And finally, you can take some steps to collection efforts. What is collection effort? And finally, and most important thing, the credit period is 30 days. And the collection period, how many days taken by the company for collecting the cash from the customers, has to be studied. If we allow the credit period for 30 days, but they are enjoying credit of 45 or 60 days and not making the payment, these customers will come under the bad account or marginal account category. This has to be studied with the help of aging schedule. Aging schedule is nothing but classifying the customers into different categories like this. And 0 to 30 days customers, that means customers who are making the payment within 30 days. And customers who are making the payment within 30 to 60 days, second category. And above 60 days customers, that means customers who are delayed in making the payment and they are taking more than 60 days in making the payment, that is more than 60 days customers. So you will get three types of categories of customers. And the last category is 60 to 90 days customers are increasing year by year. It's a clearly indication that company may get into a bankruptcy condition. So likewise, you can evaluate and monitor the receivables. So these are the most important components coming under the receivables management. The first one is terms of sales, and second one is credit analysis, and third one is collection policy. Terms of sale clearly specify how the firm sell the goods to the customers, and credit analysis studies about the character of the customers and studies about 5 C's of the customers. And third one is collection policy, how the firm collect the cash from the customers, that is known as collection policy. So these are the components of receivables management. Thank you.